whatever brought you here today. Stay with this video for a few minutes, because there's a financial question that may matter more than how much money you earn. What if your income stopped growing? Not tomorrow. Not because you suddenly lost your job. Imagine something more subtle. Your salary remains almost the same. Your business income stops expanding. Your freelance earnings plateau. Or your career reaches a level where every future increase becomes harder to achieve. Could you still afford the life you are building? For many people in India, the United States, and the United Kingdom, the answer becomes uncomfortable when they calculate it honestly. Because a stagnant income does not necessarily destroy your finances immediately. It quietly changes the mathematics of your entire life. Your rent or mortgage may rise. Food and energy costs may increase. Healthcare, education, transportation, insurance, and family responsibilities may become more expensive. Meanwhile, your income may appear stable on paper while your purchasing power slowly declines. So the first question is not, how can I earn more money? The first question is, if my income never grew again, how long could my current lifestyle survive? That question exposes a financial weakness most people never measure. Your income is not your financial security. Your financial security is the relationship between your income, your essential expenses, your debt obligations, your savings, your earning ability, and the future cost of maintaining your life. Imagine your monthly income is 80,000 Indian rupees, and your essential expenses are 40,000 Indian rupees. You have a significant amount of flexibility. But if lifestyle inflation gradually increases your unavoidable expenses to 70,000 Indian rupees, your income has not changed, and yet your financial vulnerability has increased dramatically. You are now dependent on the next raise. That is the hidden danger of income stagnation. The more your lifestyle expands, the more your future income must keep growing simply to prevent your standard of living from declining. This creates a financial trap. You may earn more money, but become less financially free. A person earning 50,000 Indian rupees with 30,000 Indian rupees of monthly expenses may have more breathing room than someone earning Indian rupee 2,000,000 with Indian rupee 1,90,000 of fixed commitments. The larger income looks impressive. The smaller financial margin determines resilience. This is why one of the most important personal finance questions is, how much money do I actually need every month to remain stable? Not to maintain every luxury, not to impress anyone, to remain functional. If your essential expenses are 40,000 Indian rupees per month and your emergency savings are Indian rupee 4,80,000, you have roughly a year of essential financial runway before considering inflation, emergencies, taxes, debt, and unexpected family obligations. But if your lifestyle requires 80,000 Indian rupees every month, that same savings cushion provides far less protection. The number in your savings account is therefore not enough. You must know what that number can actually purchase in time. This is why the real measure of an emergency fund is not simply, how much money do I have? It is, how many months of essential life can this money protect? And once income stops growing, this question becomes even more important because inflation begins working against you. If your income remains fixed while prices rise, your real income falls. The salary statement may show the same number. Your purchasing power does not. This is why someone in India may feel poorer despite receiving the same salary, while a worker in the United States or United Kingdom may face the same problem through rising housing, healthcare, transportation, food, and household costs. The financial danger is not always a dramatic collapse. Sometimes it is a slow reduction in what your income can buy. Then comes the question many people avoid. What happens if your income stops growing but your debt does not? A loan repayment does not care whether your expected promotion arrives. A credit obligation does not automatically disappear because your industry slows down. A mortgage, rent, education payment, vehicle payment, or personal debt can continue demanding cash flow while your earning power remains unchanged. This creates a dangerous mismatch. Your future income may be uncertain. Your monthly obligations may be fixed. The more of tomorrow's income has already been promised to yesterday's decisions, the less freedom you possess today. That is why income growth should never be treated as guaranteed when making long-term financial commitments. A future raise is a possibility. A monthly repayment is a responsibility. The difference between those two ideas can determine whether a person remains financially stable during a difficult period. But there's another problem hidden inside stagnant income. What happens if your skills stop growing at the same time? This may be more dangerous than a temporary income plateau. Technology, automation, and artificial intelligence are changing how work is performed across industries. The question is not simply whether machines will replace every job. That question is too simplistic. The more practical question is, will the value of my current skills increase, remain stable, or decline as technology changes the way work is done? If your income stops growing because your skills are becoming less valuable, saving alone may not solve the problem. Your financial runway can buy time. It cannot automatically restore your earning ability. That is why lifelong learning becomes a financial strategy. Learning a new technical skill, improving communication, understanding data, developing sales ability, learning how to use intelligent tools, or becoming better at solving complex problems can expand the number of ways your knowledge creates economic value. The goal is not to chase every new trend. The goal is to avoid allowing your earning ability to become dependent on one version of the economy, remaining unchanged forever. This is also why income concentration creates risk. If one employer, one profession, one client, or one business activity produces almost all your money, your financial life may be fragile even when your current income is high. The question becomes, if this income source disappeared, what ability would remain? That question reveals the difference between having income and having earning power. Income is money arriving today. Earning power is your continuing ability to create value tomorrow. A person may lose a job and still possess strong earning power. Another person may have a high income but possess very little flexibility if the environment supporting that income changes. This distinction becomes even more important psychologically. Why do people struggle so much when income stops growing? Because many people do not merely earn money. They attach identity to earning money. A higher income becomes proof of success. A promotion becomes proof of progress. A growing business becomes proof of personal worth. Then income stagnates. The financial problem becomes an emotional problem. The person may begin making desperate decisions, borrowing to preserve appearances, taking excessive investment risk, chasing unrealistic returns, or refusing to reduce expenses because a smaller lifestyle feels like personal failure. This is where financial stress can damage financial judgment. Fear makes the future feel urgent. Urgency encourages short-term decisions. Short-term decisions can create long-term obligations, and those obligations can create even more fear. Breaking that cycle requires something more than financial knowledge. It requires the courage to look at reality without allowing reality to destroy your sense of worth. This is where devotion to Lord Hanuman becomes practically relevant. The strength associated with Hanuman is not merely physical power. It represents disciplined action under pressure, courage in the presence of uncertainty, humility before learning, and devotion strong enough to continue serving a purpose when immediate results are not guaranteed. Applied to personal finance, that means having the courage to calculate your runway honestly. It means reducing dependence before dependence becomes a crisis. It means learning before your existing skills become obsolete. It means controlling lifestyle inflation before your lifestyle controls your decisions. It means understanding that asking, "Can I afford this?" is less important than asking, "Can I continue affording this if my income stops growing?" That question changes the entire meaning of financial planning. So what should you do if your income has stopped growing? First, calculate your essential monthly cash requirement. Then separate essential expenses from lifestyle expenses. Measure how many months your savings could actually support your essential life. Identify which debts cannot be paused. Examine how dependent your future is on one income source. Then ask whether your skills are becoming more valuable or less valuable in the economy you are entering. And finally, ask the most uncomfortable question. If my income remains exactly where it is today, can my financial life still become stronger? The answer can be yes. You can strengthen your finances by increasing the gap between income and expenses. You can extend your financial runway. You can reduce unnecessary fixed commitments. You can improve your skills. You can build additional earning capabilities. You can invest with an understanding of risk rather than desperation. You can create a life that does not require every future year to be financially better than the previous one. Because the deepest danger is not that your income stops growing. The deepest danger is building a life that can survive only if your income continues growing forever. And the deepest form of financial resilience is not simply earning more. It is becoming less fragile,